Flipping a house can be a great way to make money. However, unless the house you're selling is your primary residence, you're likely going to have to pay taxes on that money. And those taxes can severely cut into your profits. Depending on how you're flipping houses, the amount of taxes that you could owe will vary. So it's very important that you're accounting for the right amount of taxes. First of all, a primary residence is tax exempt. And a lot of flippers will take advantage of the primary residence tax exemption. What they'll do is they'll buy a house, they'll move into it, live in it, fix it up, then sell it for a profit and immediately buy another one. These are usually people who are flipping houses at a slower pace, and it's usually a secondary income, not their primary job. However, you have to be careful. If you're doing this too often, the CRA will come and audit you. For any other type of property that you're selling, you're likely going to have to pay taxes. You'll either have to pay a capital gains tax or a business tax. So what's the difference? Well, with a capital gain, only 50% of your profit is actually tax applicable. Whereas with a business income and you're paying business taxes on it, 100% of your profit is tax applicable. When you're selling a secondary property or a vacation home or an income producing rental property, you're going to be paying a capital gain. And many flippers make the mistake of automatically assuming that since they're selling a real estate asset, they're going to have to pay a capital gain tax. However, if you would purchase a house with the intent of fixing it up and selling it for a profit, the Canadian Revenue Agency thinks of this as a business and makes you report that as business income. Therefore, you're going to be paying business tax, which means that 100% of the profit from that flip will be added on to your yearly income and taxed at whatever your applicable tax rate is. Now, the hard thing is for the CRA to prove what your intent is. So they're going to look at several different factors. They'll look at how long you've owned the property. They'll also look at how many renovations you've done to the home. They'll look at what your occupation is. If you're someone who's in the trades or in the construction industry, it's a lot harder for you to get away with claiming a capital gain. They're also going to look at how much you put down when you purchase the property. If you put down a larger amount of money, they're less likely to come after you as a business expense than if you fully leverage the property when you bought it. The last thing they're going to look at is how frequently you buy and sell homes. When flipping a house, it's really important to have a good accountant that's knowledgeable in the house flipping business to ensure that you're not overpaying on your taxes.